In Business Tonight, investors cheering the confirmation that China is ending a 2-year-long crackdown on its tech sector. Now, top Chinese central bank officials says ratification of the financial businesses of 14 internet firms has been completed. While Chinese tech stocks listed in Hong Kong jumped, internet and gaming giant Tencent ending about 3.6% higher today. Meantime, Alibaba soared nearly 9% to a 6-month high. The last-minute cancellation of the IPO of its affiliate Ant Group was largely seen as marking the start of that crackdown. And those gains plus optimism over China's border reopening helping to lift the Hang Seng some 2% at the end of the day. And it's also at about 6-month high as well. Well, separately, China is set to tighten listing guidelines on its main stock exchanges to funnel funding to strategic sectors. Now, a Financial Times report citing sources says China's stock regulator has designated so-called red light and yellow light sectors. Well, firms in red light sectors will not be able to seek equity financing on the Shanghai and Shenzhen main exchanges. As for yellow light sectors, their listing requests will come under scrutiny if their growth relies heavily on debt for expansion. And for more, Sean Ryan joins us now from Shanghai. He is the managing director at China Market Research Group. Well, Sean, a 2-year crackdown on China's tech sector that seems to be ending. Why now? And does this softening have anything to do with China needing these big tech firms to sort of help propel growth?
It's great to see you, Liz. Well, as many in the audience know, I've been one of the biggest bulls on China for the last 25 years. But when it came to 2022, I was one of the biggest bears. The economy is in a lot worse shape than a lot of people realize. You have on the real estate sector, prices are dropping and there's no sales volume. Chinese consumers right now expect that prices will continue to drop. So even though the government is pumping liquidity into the system, shoppers aren't buying. So the Chinese government has had to ease the crackdown on the tech sector. Otherwise, who knows how low the Chinese economy could go. Now, let me be clear, Liz. The crackdown initially was quite good. Alibaba, Tencent were basically an oligopoly, and they were stifling fair competition. They were stifling fair profits for retailers, and they were really hurting innovation within the country because they had their fingers into too many different ecosystems throughout the country, from tech to finance to insurance to retail to movies. So the government was right to crack down on it. However, the government kind of cut too far to the bone, and they started stopping some of the innovation, some of the entrepreneurial zeal, and some of the investment speculation that is needed to move an economy forward. So you have COVID, you have the weak economy, you have China's government cutting too far to the bone. They finally have righted themselves, and they're putting the crackdown, they're easing off it, letting the games companies like Tencent and NetEase publish new games for the first time in 2 years. So there's reason to be optimistic that the crackdown is not ended, but it's going to be eased. But again, investors need to be concerned, Liz. The economy is a lot worse off than people realize, even with the end of zero COVID policies.
Yeah, so in a way, then do you think it is too early to rejoice then? What sort of other challenges do you foresee that, this sector will need to overcome in the year? And also, with the end of this crackdown, so to speak, can China's tech sector sort of replicate its pre-COVID growth rate?
So I do think it's a little too premature to rejoice. You should, put the cork back into the champagne bottle. I think a lot of investors were too depressed, too negative in October and November of 2022. They're now too optimistic right now because, look, at the end of the day, Xi Jinping is in charge of the country. And Xi Jinping wants to shift towards a socialist economy a lot more than any of his predecessors like Jiang Zemin or Hu Jintao, who are much more willing to accept capitalism into the country. Xi Jinping wants to have a common prosperity drive, and that's what he's pushing. Investors, don't forget, we're now undergoing a hard shift towards socialism. And what that means is it's going to be impossible for companies to get the same kind of fat margins that they got maybe 5-6 years ago. That's why I think investors are a little bit, too excited about what's going on in the country because they have to take a step back. Over the next 3 to 5 years, the government is going to allow fat margins, not just in tech, but as you saw in the sectors that have the red light for an IPO in the Shanghai or Shenzhen bourses. That would be baijiu, alcohol. That would be the education sector. So the government is really trying to control fat margins so that you have a more fair and equitable society. Now, it's hard to criticize that, right? You can't say that Jack Ma should be so rich and there's 750 million poor people. So I think most people in China support these policies. But at the end of the day, I don't want to say it's becoming anti-rich, but it's becoming a lot harder for rich people to be able to operate and get the fat margins that they used to get. So the tech sector could be in for a rougher time 2 years, 3 years down the line than a lot of investors think, Liz.
Well, Sean, going deeper into the property bit, you say shoppers, they're not buying. And in fact, top official Guo Shuting today also commenting on the property sector, saying that, the government, it will prioritize improving the balance sheets of those top developers. Again, given that the damage we've seen the sector undergo, what is your take on this? Is this enough to sort of fire up home buying?
So it's kind of confusing, right? On the one hand, the Chinese government is trying to bail out the real estate sector. They've got 5 large state-owned banks, increasing the liquidity to about 100 billion US, or by 100 billion US to companies like an Evergrande or a Shimao that are struggling under being able to finish apartments and then being able to sell them. So the government is putting money in. The problem is the government is helping prop up the sector to create more production and allow Evergrandes and Shimaos of the world to finish building their apartments so that they can give the apartments to the home buyers. The problem is the demand structure. So when you're running an economy, you can either focus on investment or on demand. Right now, the government is focusing on investment. I'm not convinced that the demand is there. In 2022, you have to remember there was a lot of job cuts, unpaid furloughs, a lot of salary cuts. So a lot of consumers just aren't feeling that wealthy right now. And so they don't want to make a big purchase on a house. So they're going to take a wait and see attitude and see, will prices remain stable? Will they come down? What's going to happen to the RMB? So I'm actually cautiously optimistic on the real estate sector, but I don't think you're going to see a return to the go-go heady days of 2003 to 2018. You also have to remember, the Chinese government also said yesterday or today that, again, homes are meant to be lived in, not to be investments. So I think they're sort of sending mixed signals to the marketplace. And for me, I tend to be conservative. I think real estate's not going to grow like gangbusters.
Well, Sean, thank you so much for speaking with us. Sean Rang, the China Market Research Group.